In little than 2 weeks, Elon Musk rose to become one of the social media giant's major owners, announced that he would join the board of directors, then withdrew his application, and then launched a hostile takeover effort. Twitter is now fighting back, attempting to protect its independence from the rest of the internet. Management implemented a limited-term shareholder rights plan, often known as a poison pill, on Friday in the event that Musk's unwanted $43 billion best and final bid is rejected. However, what exactly is a so-called corporate poison pill, and why would Twitter want to take one? The poison pill is a tactic for defending oneself. A poison pill is designed to deter an outside actor from assuming control by making the transaction too costly for them. Twitter said in a statement, "The rights plan will reduce the likelihood that any entity, person or group control of Twitter through open market accumulation without paying all shareholders an appropriate control premium or without providing the board sufficient time to make informed judgments and take actions that are in the best interests of shareholders." Let us talk about how poison pills function and what they are. An acquirer's interest in a potential purchase is diminished when poison pills are used. Shareholders may benefit from the approach by purchasing more shares at a low price. By purchasing additional shares, the hostile player's ownership status is diluted. For example, the value of the shares controlled by the business decreases as a result of the increased watering down. The flip-in and flip-over techniques are two variations of the same approach that are used in different situations. Current shareholders, with the exception of the acquirer, may benefit from the flip-in approach by purchasing more shares at a discount. In turn, this results in rapid rewards for shareholders and a decreased ownership position for the acquirer, making the transaction less enticing overall. An alternative technique, known as a flip-over plan, allows shareholders of the target firm to acquire shares of the acquiring company at a discounted price if the acquisition is successful. It follows that the stake in the purchasing business is reduced, making the offer less attractive for the company threatening a hostile takeover. Let us have a look at some examples of its use. Netflix. In 2012, Netflix developed a poison pill, shareholder rights plan, in order to deter Karl Icahn from launching a hostile acquisition of the company. When Netflix learned that billionaire investor Karl Icahn had bought a 10% share in the firm, the company went on the defensive. In the event of an effort to acquire a significant portion of Netflix without board permission, there would be a rush of new shares issued into the market, making any investment acquisition exceedingly expensive. Papa John's Pizza. Also in July 2018, the board of directors of Papa John's Pizza adopted the poison pill in order to prevent expelled founder John Schnatter from regaining control over the firm. He was the company's biggest investor, accounting for 30% of the company's total stock. Corporations such as McDonald's and the Walt Disney Company have used this tactic to stave off aggressive investors, among other things. Let us know your opinion on the situation in the comments section. Can you write one example of a corporate poison pill in the past? Thanks for watching, and please subscribe to the channel for more interesting tech news.